Would you walk me through BlackRock's approach to creating a model portfolio and target allocation ones in particular?
Thanks, Greg. The target allocation models are designed for financial advisors and their clients to help meet their financial and life goals. We've organized our models around simple benchmarks, performance benchmarks that are percentage equity, percentage bond. So 60-40 being 60% equity, 40% bond, 40-60 being 40 equity, 60 bond. We try and stick to that general guidance while using granular exposures inside of every asset class to add value into tilt and time assets.
Well, both stocks and bonds have faltered this year. How did this affect your model portfolio creation?
We've brought in risk throughout the year and have managed through doing that to keep performance ahead of those performance benchmarks. One of the ways we did it at the end of last year was to include real assets in the portfolio that have strongly outperformed traditional equity and fixed income.
We've seen wild swings in the market. How have you dealt with this volatility when you're making those portfolios?
We expect the volatility to continue. The drivers for it are an unprecedented set of economic stimulus that came into effect after the pandemic, and what we're experiencing right now is payback for that really powerful stimulus. So the portfolios are continuing to navigate this highly volatile environment. We think it's going to take a while for the volatility to kind of simmer down, but we're focused on the long term in terms of keeping those allocations at good targets.
And volatility also creates opportunities. Are you taking advantage of that volatility as well?
We absolutely are. We see a lot of opportunity right now in different pockets of fixed income, which have just gotten battered in the last 12 months. And within equities, rotating into styles that we think are going to have more resilient performance over the coming period.
And then finally, to bring it all back around, what's your outlook for the 60-40 portfolio? Because a lot of people say it's dead because it hasn't worked this year.
We made a call on 60-40 a little over 2 years ago to move into alternative assets and real assets from the fixed income portion of the book. So something like a 60-40 becomes a 60-20-20 approximately, with 20% fixed income and 20% alternative in addition to the stock allocation. What we found is that those liquid long-short assets and real assets have strongly outperformed the asset class that we funded from, which was fixed income, over the last 24 months. We have a positive outlook for it on the go-forward basis as well, particularly now that cash rates are approaching 4%.
All right, well, thanks a lot for coming on and talking about it.
You're welcome.